Welcome to the deep dive. We're here to, really get under the hood of the big economic shifts by digging into the source material.
That's right.
And today, we are tackling something absolutely essential, but maybe not always top of mind. We're talking about the engine behind eating out the food away from home logistics network.
Yeah, specifically, we're focusing this deep dive on U.S. Foods Holding Corporation. Stock ticker USFD. They're the second biggest player in the U.S. food service distribution game.
Okay.
And for you listening, the mission today is pretty critical. We want to move past just picturing U.S. Foods as, a bunch of trucks.
Right, more than just delivery.
Exactly. We need to understand how things like technology, potential big mergers, and this constant hunt for better margins are actually reshaping this huge, like $400 billion industry right now.
And the backdrop here is just massive growth. This whole food away from home, or FAFH market. It's not just big, it's exploding.
Staggering is the word. Projections show the total U.S. food service market hitting something like $2.07 trillion by 2032. That's a compound annual growth rate of 7.0%. Pretty robust.
7% CAGR, wow. So this isn't some niche thing. It's fundamental to how we spend money on food now.
And here's the real kicker, the consumer behavior shift that drives everything. In 2024, FAFH spending hit a record 58.9% of all the money spent on food in the U.S.
Wait, say that again, over half?
Over half.
Yeah.
Think about that. More than 50 cents of every single food dollar is now spent outside the home. At restaurants, cafes, hospitals, you name it.
Okay.
And USFD. They're the crucial link. Often invisible, maybe, but they're delivering the actual ingredients that make up that 58.9%.
So let's pin down exactly who USFD is. What's their core business?
At its heart, it's marketing, selling, and distributing a massive range of products. We're talking around 400,000 different items or SKUs.
400,000? That's a lot of stuff.
It really is. Everything from, fresh fish, frozen chicken, to dry pasta, canned goods, even equipment like ovens, plus non-food supplies like napkins, cleaning chemicals, the works.
So literally everything a restaurant or cafeteria needs to operate.
Pretty much. A complete supply chain solution. And their tagline kind of sums it up. Great food, made easy.
Made easy. Okay, so that implies more than just delivery.
Exactly. It signals they're not just dropping off products, they're offering solutions. In the restaurant world, which is super high pressure, often low margin, making things easy, ordering, managing inventory, controlling costs, that's the real value proposition.
Okay, but we can't really talk about USFD in a vacuum right now, can we? There's some major news swirling.
No, we absolutely have to address the elephant in the room straight away. This is a pivotal moment for them.
The potential merger.
Yes. The news broke in September 2025. USFD confirmed they are actively, formally exploring a potential business combination, a merger with Performance Food Group, PFG.
PFG being the number 3 player.
Exactly. And look, this isn't just your standard M&A deal. You could almost call it a strategic arms race response.
An arms race. Why?
Because this proposed merger, it signals this urgent need for combined scale. Scale to fund the massive technology and operational upgrades everyone knows are needed to survive long-term in this kind of market. It's oligopolistic.
Okay, we'll definitely need to unpack the why behind that later, but it certainly sets the stage. High-stakes stuff.
Absolutely defines the context for today's deep dive.
All right, let's get concrete for a minute. Paint a picture of USFD's actual physical operations. How big are we talking?
Okay, so visualize this. Over 60 distribution centers spread across the country. A fleet of about 6,000 trucks running constantly. And nearly 30,000 employees, associates, they call them, keeping it all moving.
60 DCs, 6,000 trucks. That's a serious footprint.
It is. And that physical backbone translates into serious money. Fiscal year 2024. Net sales hit $37.9 billion.
Almost $38 billion. Wow. And how does that break down? Is it all just canned goods?
Not at all. And the breakdown shows the complexity. The biggest slice in 2024 was actually meat and seafood, $12.9 billion in sales.
$12.9 billion just in meat and seafood.
Yep. And think about what that means logistically. You're managing a massive perishable supply chain. Needs specialized cold storage, really fast turnover, complex quality control. It's demanding.
Right, compared to shelf-stable stuff.
Exactly.
Okay.
Dry grocery products like pasta or flour, that came in at $6.6 billion. A refrigerated and frozen grocery, think dairy, frozen vegetables, that was another $6.4 billion.
So multiple huge temperature-sensitive supply chains running side by side all day, every day.
You got it. But here's where the strategy gets interesting, according to the sources. It's not just about what they move, but who they move it for. They're very selective.
Selective. They're the number two player. Wouldn't they want every customer they can get?
You'd think so, maybe.
Yeah.
But no, it's not a scattergun approach. It's really a laser focus on the profitability of the customer segment.
Okay, so who are they targeting? You mentioned independent restaurants earlier. They can be tough customers, right? High failure rate, maybe very price sensitive.
That's exactly the tension, isn't it?
Yep.
Independents are volatile as a sector, sure, but they also represent the single largest customer type in the whole industry. Nearly 59% of all food service sales happen there.
59%. Okay, that's huge.
So USFD's angle is, instead of just competing on price for them, they develop these business solutions, the tech tools, the consulting we mentioned, to make those independents run better, more efficiently.
So they try to lock them in as higher value clients, not just commodity buyers.
Precisely. They also go after small and regional chains, and then the institutional side, healthcare, like hospitals and nursing homes, and hospitality, like hotels. These often have more stable contracts, maybe customized needs, which can justify better margins.
And is there proof this focus is working? Does the data show it?
Yeah, the 2024 case volume numbers seem to back it up. Their strongest growth wasn't across the board. It was targeted.
Yeah.
Healthcare volume, up 5.7%. That likely reflects those stable contracts, consistent demand,
Okay.
and independent restaurants, their main target. Solid growth, too, up 4.4% in case volume. That suggests their strategy, the consulting, the differentiated products, it's actually pulling profitable business away from competitors in that key segment.
Interesting. So this targeted approach feeds into the broader industry structure. You called it an oligopoly within a fragmented market.
Exactly. The total U.S. food service distribution pie is around $370 billion.
Yeah.
And it's fragmented because you've got thousands of small, local, often family-run distributors serving their specific region.
Right, the little guys.
But on the national stage, it's dominated by just three big players.
An oligopoly.
And the lineup is clear from the sources. Cisco SYY is the undisputed leader, king of the hill, around 17% market share.
Yep. Then you've got USFD, our focus today, holding down the number 2 spot with about 10% share, based on that nearly $38 billion in sales. And Performance Food Group, PFG, at number 3, the potential merger partner.
Correct. And those three, they basically dictate the terms nationally pricing trends, logistics standards, the pace of technology adoption.
Which leads right into why this business is so tough.
Absolutely. It's a notoriously difficult, low-margin environment.
Define low margin for us in this context. What does that really mean day to day?
It means tiny changes can wipe out profit. A spike in diesel fuel prices. That hurts. Labor costs go up. Big impact. A refrigeration unit fails and spoils a truckload of seafood. Disaster for that route's profitability.
Ouch.
Plus, you've got intense competition, constant pressure to match prices, and these massive fixed costs. Think warehouses, trucks, refrigeration systems. It all costs a fortune just to maintain.
It sounds incredibly capital intensive. You mentioned the physical assets, but what about the people? That struck me in the sources.
Yeah, the human capital piece is huge. Labor challenges are a constant issue. Look at their workforce breakdown. Drivers make up 31%, and warehouse staff are another 42%.
So almost 3/4, 73% of their workforce is directly tied to the physical logistics, driving, and warehousing.
Exactly.
So how vulnerable does that make their profit margins to things like wage inflation, which we've seen a lot of? And maybe more importantly, what are they actively doing about that pressure right now?
That is a fantastic question, and it leads perfectly into why their strategic shifts are so vital. You're absolutely right. The logistics labor base is very exposed to wage pressures. If driver wages climb, say, 5%, that eats directly into those already thin margins.
So what's the counter strategy?
It's really two-pronged. First, squeeze out every bit of efficiency using digital tools. Make sure every truck route is perfectly optimized, minimizing wasted miles, fuel, and driver time. MOXL's here.
Okay, optimize the routes.
Second, and this is crucial for the long term, invest heavily in automation within the distribution centers. That's why you see their capital expenditures, their CapEx, going up.
Replacing human labor with machines.
Essentially, yes. You're swapping potentially volatile, inflation-sensitive labor costs for higher, but stable, fixed costs through robots, the automated sorting systems. The goal is to build more predictable, resilient margins over the long haul.
Okay, so we've established it's low margin, hyper-competitive, high fixed costs, labor pressures. Sounds brutal, which really begs the question, how does USFD actually differentiate itself? I mean, anyone can deliver a box of frozen chicken, right?
That's the core challenge, and this is where USFD's strategy really pivots. They have to be more than just the cheapest delivery service. They can't win a race to the bottom on price alone.
So what's the pivot?
The clear strategic direction is moving from being just a logistics provider to becoming more like an operational consultant for their customers, especially those independent restaurants.
An operational consultant. Okay, unpack that.
They're using digital tools not just to take orders, but to get deeply embedded in how the customer runs their business day to day. The idea is to make their whole offering stickier.
Stickier, meaning harder for the customer to leave.
Exactly. If you provide tools that help a restaurant owner manage their entire inventory, track food costs accurately, maybe even help with menu planning, switching to another distributor suddenly becomes a massive headache.
Right, because you'd be ripping out a system they rely on for financial management, not just ordering. That makes sense. High switching costs.
Precisely. And the main engine for this, their sort of digital moat, is this e-commerce platform called MOX. MOX.
MOX. Okay. What does it do?
Think of it as the customer's operating system for dealing with USFD and increasingly for running their own kitchen. It handles the basics, like ordering, obviously, but it also does inventory tracking, provides detailed cost management reports, helps manage recipes.
That sounds pretty comprehensive. Are customers actually using it?
That's the striking part. The adoption rate is apparently huge. 90% customer adoption.
90%. Wow. So almost every USFD customer is plugged into this digital ecosystem.
Seems so. But the real genius, maybe the real moneymaker within MLX, is this integrated AI recommendation engine.
Ah, artificial intelligence. So it's suggesting things to buy, like, hey, avocados are on sale this week.
It's way more sophisticated than just flagging sales. This AI looks at the specific customer's buying history. It considers seasonality, and those local market trends, maybe even their current inventory levels if they're using that feature.
Okay.
And it intelligently cross-sells and upsells. So maybe a restaurant orders a particular type of ground beef all the time. MOX might suggest, hey, customers who buy this beef also often buy our high-margin private label brioche buns, or consider this premium grill cleaner designed for kitchens like yours. Right there at the point of order.
And that actually works. People add those items.
Apparently, yes.
Yeah.
Management claims this feature increases the average order size by 1.5 cases.
Okay, let's pause there. 1.5 extra cases per order. In a business where the profit on one case might only be, what, a few dollars?
Could be $5, $6, $7, depending on the item.
Yeah.
Maybe less, maybe more.
So adding 1.5 cases, potentially across thousands, tens of thousands of orders every day, that adds up incredibly fast. It's almost pure profit leverage from the AI suggestion.
It's a fantastic example of a self-help mechanism. Low cost to implement relative to the potential profit boost. Pure margin enhancement.
Okay, so MOXE is the digital storefront and brain. What about the actual delivery? You mentioned another innovation there.
Right, if MOXE handles the digital side, Pronto handles the physical, but in a new way. Pronto is their innovative last-mile delivery service. It complements the big trucks.
Pronto, meaning fast. How is it different from standard delivery?
Traditional distribution relies on those big semi-trucks, running on fixed schedules, delivering large bulk orders. That's efficient for big customers. But Pronto uses smaller trucks.
Smaller trucks, so more nimble.
Exactly. They can offer more frequent, more flexible deliveries. This is crucial for customers who don't have huge storage space, like maybe a small restaurant in a dense city center, or for someone who needs an emergency top-up between their main deliveries.
Ah, catering to needs the big trucks can't easily meet, especially for those independents again.
Precisely. An independent spot might not have the walk-in cooler space, or frankly, the cash flow, to handle a week's worth of inventory arriving all at once. Pronto lets them manage inventory much tighter, keep things fresher, improve their cash flow. It solves a real pain point.
Does it work? Is it growing?
Oh yeah. The growth trajectory is pretty explosive. Pronto finished 2024 with an annualized sales run rate of $730 million.
$730 million from a small truck service.
Yep. And based on that success, management jacked up the long-term target. They raised it by 50%, now aiming for $1.5 billion in annual sales from Pronto by 2027.
$1.5 billion. Wow.
They call it Pronto penetration. And they say customers who use Pronto show a double-digit percentage lift in their total case volume bought from USFD.
So it's not just convenience, it's driving more overall business from those customers. Clear proof that solving that inventory problem builds serious loyalty.
Definitely seems that way. Now, alongside the tech and logistics innovation, we absolutely have to talk about the products themselves specifically, the exclusive brands. They're private labels.
Right, store brands, basically. Why are those so important in this industry?
In almost any business that deals with commodities, private labels are a golden ticket for margin enhancement. Because USFD controls the whole process. The sourcing, the specifications, the branding, the marketing. They can capture much more profit per case compared to selling a national brand where the manufacturer takes a big cut.
Makes sense. They control the value chain. How extensive is their private label program?
It's significant. They've developed a whole tiered portfolio, 22 distinct proprietary brands, different price points, different quality levels, covering about 9,500 individual products.
22 brands, that's a lot. So they can offer, say, a budget option and a premium option under their own labels.
Exactly. And strategically, they can position a premium private label product that might offer them, say, a 30% higher margin than the equivalent national brand sitting next to it on the virtual shelf in MOX.
30% higher margin? Okay, that's a huge lever to pull.
Massive. And to make sure those private labels don't just sit there, but actually resonate with chefs and restaurant owners looking for new ideas, they have this platform called Scoop.
Scoop, like getting the inside scoop.
Kinda, yeah.
Yeah.
It's a structured launch program. Twice a year, USFD rolls out a batch of new, carefully selected private label products that are designed to be on trend.
On trend how?
Think seasonal ingredients, maybe pre-prepared items that save kitchen labor, interesting ethnic flavors, plant-based options, things that allow a restaurant to easily refresh its menu without totally changing suppliers.
So it positions USFD as an innovation partner, not just a supplier of staples. Helps keep things fresh.
Exactly. Drives bigger orders, more profitable orders, and builds loyalty because they're seen as bringing ideas, not just boxes.
And there's a sustainability angle here too, right?
Yes, and it's becoming quite significant. They have a specific private label portfolio called Serve Good. These products meet certain environmental or social responsibility criteria.
And how's that doing? Is it just niche?
Apparently not anymore. Serve Goody surpassed $1 billion in annual sales for the first time ever in 2024. That tells you sustainability isn't just a talking point. It's becoming a real driver of sales within their high-margin private label strategy.
$1 billion in sustainable private labels. That's impressive. Hashtag tag IVV. Financial performance and execution success.
So we've talked about all these pieces, the MOX tech, the Pronto trucks, the Scoop private labels. But, at the end of the day, strategies only matter if they actually show up on the bottom line.
Right. Does the financial performance reflect all this innovation? Is the execution there?
Well, the narrative really clicks into gear with the leadership change. David Flipman took over as CEO in January 2023. He came in with a clear mandate: drive efficiency, boost those margins.
And did he deliver?
Seems so. He successfully wrapped up the company's 2022-2024 strategic plan, and, crucially, the sources say he exceeded the key target for adjusted EBITDA in 2024. He hit the goal, maybe even beat it slightly.
Okay, meeting targets is good. Builds credibility.
Absolutely. And he didn't rest on his laurels. He immediately leveraged that success to launch the next plan for 2025 through 2027. And this one is way more ambitious.
How ambitious?
The targets are pretty aggressive for a distributor. They're aiming for a 5% compound annual growth rate in net sales. Okay, that's solid. But then, a 10% CAGR for adjusted EBITDA.
Double the rate of sales growth for profit growth. That's the goal again.
Exactly. And even more striking, a projected 20% CAGR for adjusted diluted earnings per share. 20% earnings growth per year for 3 years.
Wow. Those targets signal enormous confidence that they can fundamentally change the profitability profile of this business.
They really do.
Yeah.
Which brings us perfectly to what you call the AHA. A moment earlier, the hard numbers, the quantitative proof that the strategy is actually working right now.
Let's see it. Fiscal year 2024 performance. What did the top line look like?
Net sales grew 6.4% year over year, hitting that record $37.9 billion we mentioned. That's respectable growth, probably keeping pace with or slightly ahead of the market.
Okay, 6.4% sales growth. Decent, but what about the profits?
This is the key metric. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a common measure of operating profitability. It grew 11.7% to reach $1.74 billion.
11.7%. Okay, that is nearly double the rate of sales growth.
Exactly. In a business like distribution, growing profits that much faster than sales is really, really hard to do consistently. It means you're not just getting bigger, You're getting significantly more profitable on every dollar of revenue you bring in.
And the direct evidence for that is the margin itself.
Precisely. The adjusted EBITDA margin expanded significantly. It went from 3.8% back in 2022 up to 4.6% in 2024.
Okay, 3.8% to 4.6%. That's an 80 basis point improvement.
80 basis points. Now, that might sound small, but in a low-margin, high-volume business like this, 80 basis points is massive.
Can you quantify that? What does 80 basis points actually mean in dollar terms on $38 billion in sales? And how hard is that to achieve?
Let's break it down. A basis point is 1/100%. So 80 basis points is 0.8%. Applying that 0.8% improvement to their $37.9 billion sales base. You're talking roughly $300 million in extra annual EBITDA, compared to if margins had just stayed flat from 2022 levels.
$300 million.
Yeah.
Just from margin improvement.
Roughly, yeah. And achieving that kind of expansion takes incredible focus across the board. It's direct quantitative evidence that those self-help programs we discussed are firing on all cylinders.
The pricing tools and MOX.
Yep. The deliberate shift in sales mix towards those 22 higher-margin private label brands,
Right.
and the operational efficiency gains coming from things like warehouse automation and better logistics planning. It proves they aren't just benefiting from, say, food price inflation passing through. They are actively driving internal profit leverage.
That's a critical distinction. They're manufacturing their own margin improvement, not just riding a wave.
Couldn't have said it better myself.
Yeah.
And beyond the profitability, their ability to generate cold, hard cash looks pretty strong, too.
Cash flow. Always important, especially if they're investing heavily.
Absolutely vital. This business model, when run well, does throw off a lot of cash.
Yeah.
In 2024, they generated $1.17 billion in cash flow just from their operating activities.
$1,170,000,000. How does that compare to their net income?
Interestingly, it's more than double their reported GAAP net income, which was $494 million for the year.
Double. Why such a big difference?
It's pretty common in industries with heavy depreciation and amortization charges on assets like trucks and warehouses. Those are non-cash charges that reduce net income but don't affect actual cash flow. So operating cash flow often looks much stronger than net income. But this level, over $1 billion, is what gives them the firepower to fund those big CapEx projects and return cash to shareholders.
Okay, let's circle back to that potential PFG merger we mentioned up front. Why now? And why is this such a potential earthquake for the industry?
Right. So in September 2025, U.S. Foods and PFG officially entered into what's called a clean team agreement. This is the formal starting gun for exploring a business combination.
A clean team agreement. What does that mean exactly? It sounds like something out of compliance.
It kind of is, actually. When two major competitors like this think about merging, they absolutely cannot just start sharing sensitive competitive information like detailed customer pricing lists or their secret strategic plans. Antitrust laws forbid that.
Okay, so how do they figure out if a merger even makes sense financially?
That's where the clean team comes in. It's usually a small group of external advisors, lawyers, consultants, bankers, plus maybe a few very senior executives from each company who are strictly firewalled off from the day-to-day business.
Firewalled.
Meaning they can look at the highly confidential data from both companies, specifically to calculate potential cost savings or synergies from a merger, without that sensitive info leaking back into the regular operations and violating competition laws.
Got it. So the fact they've set up a clean team means this is a very serious, formal exploration.
Extremely serious. It signals the incredibly high stakes involved. So why now? The analysis really points squarely at that technological arms race we discussed.
The need to spend big on automation and digital.
Exactly. Both USFD and PFG know that the capital investment required over the next 5 to 10 years is just massive. We mentioned USFD alone is projecting $400 million in CapEx for 2025, funding automated warehouses and tech development. PFG faces similar pressures.
So merging helps them afford it.
It does two huge things almost instantly. It creates massive scale, and it unlocks potentially enormous cost synergies.
Okay, scale is obvious. Combining number 2 and number 3 creates a much stronger competitor to Cisco. What about synergies? Where do those come from?
Think about it. Network rationalization is a big one. They could close overlapping distribution centers, optimize delivery routes across the combined network, reduce corporate overhead. You don't need 2 CEOs, 2 CFOs, etc. And maybe the biggest one, massively increase purchasing power when buying those 400,000 SKUs from suppliers.
Billions in potential savings over time, probably.
Easily. But here's the strategic kicker. Those savings aren't necessarily just meant to flow straight to the bottom line, although that would be nice for shareholders.
They're meant to be reinvested.
That seems to be the core strategic logic. The goal is to use those synergy savings to fund a unified and ultimately superior technology and automation strategy. Build the best digital platform, roll out the most advanced automated fulfillment centers across the combined larger network.
So it's about creating a tech-enabled giant that can truly go head-to-head with Cisco on efficiency and capability for the long run.
Precisely. It's a forward-looking defensive and offensive move, secure technological parity, maybe even superiority, and lock in those margins against the industry leader.
Okay, that makes the merger logic much clearer. Now, setting aside the merger possibility for a second, let's look at USFD's own capital allocation philosophy as it stands today. How do they decide where the money goes?
They have a very clear stated framework. Priority number one, internal investments to drive organic growth. That's funding MOS, Pronto, the warehouse automation.
Makes sense. Feed the core business first.
Priority number two, strategic tuck-in acquisitions.
Yeah.
Smaller deals, maybe buying a regional distributor to fill a geographic gap, or acquiring a company with unique product capabilities.
Okay. And number three?
Shareholder returns.
That hierarchy tells you a lot, doesn't it? Reinvesting in the business itself comes first.
Absolutely. And that $400 million CapEx projection for 2025 really underscores priority one. That money is funding the essential infrastructure, the tech, the automation that underpins their whole strategy. That level of CapEx, it represents about 29% of their 2024 operating cash flow. That's a serious commitment to self-funding their future growth.
And for shareholders, they don't pay a dividend, right?
Correct. No dividend. The focus for shareholder returns has been squarely on share repurchases, buybacks.
And have they been active there?
Incredibly active.
Yeah.
In 2024 alone, they bought back $958 million worth of their own stock, nearly $1 billion. And then in May 2025, they authorized a new $1 billion share repurchase program.
Wow, that's aggressive. What does that signal?
It signals huge confidence from management. They clearly believe their stock is undervalued relative to the future cash flows they expect to generate from this strategy taking hold. It's a strong vote of confidence in their own execution.
And this is all happening while they're managing their debt.
Yes, and that's another sign of disciplined execution, especially under the new CEO. Their total net debt is still pretty chunky, around $4.8 billion. But they've made significant progress in paying it down relative to their earnings.
They had a leverage target, right?
They did, a target range of 2.5x to 3.0x net debt to adjusted EBITDA, and by mid-2025, they successfully got their leverage down to 2.6x, hitting the lower end of that target range.
So they focused on strengthening the balance sheet first.
Deleveraged first, reached their target, then pivoted to aggressively returning capital to shareholders via buybacks. That sequence suggests a prudent, thoughtful approach. Builds confidence that the turnaround is on solid footing. #TagVS. Competitive positioning, risks, and valuation context.
Let's sharpen the focus now on how USFD stacks up against its peers, especially PFG, the potential merger partner. You mentioned differences in profitability.
Yeah, this comparison is really revealing about their distinct strategies. Look at gross margin, that's sales minus the cost of goods sold.
Yeah.
USFD's trailing 12-month gross margin is sitting around 17.4%.
17.4%, okay. How does PFG compare?
Significantly lower. PFG's gross margin is around 12.4%.
12.4. Wow, that's a 5 percentage point difference? Nearly 500 basis points. That's huge.
It's a massive gap. And according to the sources, it's a direct result of those deliberate strategic choices we've been discussing.
Meaning USFD's focus on certain customers.
Exactly. USFD has consciously prioritized that higher margin, but more fragmented, independent restaurant segment. That's where their private labels, their MOX tools, their Pronto service can command more value, justifying a better margin.
And PFG, where does their volume come from?
PFG has a very large presence in the convenience store distribution channel, especially through their Corp business segment, which they acquired. C-stores are typically lower margin, high volume, very consistent business.
So PFG emphasizes huge volume in stable but less profitable channels, while USFD targets higher value, potentially more complex but more profitable segments.
That's a great way to put it. USFD has arguably chosen value capture over just pure volume or breadth. And that strategic choice seems to be why they've been able to drive their margin expansion so effectively recently.
But USFD isn't perfect. What's their main competitive weakness?
It really comes down to scale, specifically compared to the giant Cisco. Remember those distribution center numbers? Cisco operates something like 337 DCs across North America.
337 compared to USFD's 70-ish.
Right. That sheer scale gives Cisco a couple of major advantages. First, massive purchasing power. They can likely negotiate better prices from the big national brand food manufacturers simply due to their volume.
Economy of scale in purchasing. Makes sense.
Second, network density. With DCs almost everywhere, Cisco could potentially offer faster, cheaper, maybe more flexible delivery options in more geographic areas than USFD can currently cover.
So that network disadvantage, that scale gap relative to Cisco, that's probably the biggest single operational driver behind exploring the PFG merger, isn't it? Combining forces to try and close that gap.
Arguably, yes. It's the most logical strategic rationale from an operational standpoint.
Okay. So competitive pressures are intense. What are the biggest risks that could derail this positive trajectory for USFD?
You can group the risks into a couple buckets. First, there's internal execution risk. This is always a big one when a company's undergoing a major strategic shift or turnaround.
Meaning, can they actually pull it off?
Exactly. They've bet heavily on successfully scaling up Pronto to that $1.5 billion target. They need FOS to keep driving efficiency and higher margin sales. Failure to execute flawlessly on these big operational changes could really stumble them.
And the merger itself adds risk.
Huge execution risk there. Integrating two massive companies like USFD and PFG, if it happens, would be incredibly complex. Merging cultures, combining IT systems, rationalizing networks without disrupting service. Any failure there could destroy value instead of creating it.
Okay, that's internal execution. What about external threats?
The usual suspects for this industry. It's cyclical. If the economy tanks and people stop dining out as much, USFD's sales volumes will suffer, period. Discretionary spending pullback is a constant macro risk.
Makes sense. What else?
Persistent commodity price volatility is another one. Remember that $12.9 billion in meat and seafood? If beef or fish prices swing wildly, it's very hard to manage margins predictably. And of course, intense price competition is always lurking. Cisco or PFG could always decide to get aggressive on price to win share.
Right. Those low margins mean a price war would be painful.
Extremely painful. But there's one more nuanced risk worth mentioning. Maybe call it the margin growth paradox.
Okay, what's that?
USFD's strategy is all about pushing for higher margins, heavily promoting private labels, focusing on profitable independence, using tech to optimize. But if they push too hard on margin,
They risk alienating someone.
potentially, yeah, they could alienate large chain customers who are more price sensitive and prefer national brands, or they could annoy the big national brand suppliers themselves, who might see USFD favoring its own products too much.
And that could backfire.
It could. If large customers feel squeezed, they might defect to Cisco. Or if big suppliers feel shut out, they might offer competitors better deals, triggering those price wars we just mentioned. So there's a balancing act, pushing for margin without pushing so hard it caps your long-term growth potential.
That's a really interesting tension.
Hmm.
Okay, last piece, valuation. How does the market see USFD right now? What are the multiples telling us?
This is where things look a bit unusual at first glance. If you look at the raw trailing 12-month price-to-earnings ratio, the TTM PE, it looks pretty high for a distributor, around 32.3x.
32 times earnings. How does that compare?
It's significantly higher than Cisco, which trades around 17.6x TTM PE, and well above the broader industry average, which is maybe closer to 21x.
So USFD looks expensive based on past earnings.
On the surface, yes. But that high trailing PE isn't really about the past. It suggests the market is actively pricing in the future success of this whole turnaround strategy we've been discussing.
The market believes the margin expansion story.
Exactly. In the distribution world, which normally gets valued like a utility or a slow-growth industrial company, a 32x trailing PE is a huge vote of confidence. The market is betting that management will successfully execute.
And the forward-looking numbers support that bet.
They do. That high trailing PE is expected to contract sharply when you look at forward earnings estimates. The forward PE, based on analyst projections for next year's earnings, is estimated to be much closer to 17.8x.
Back in line with Cisco's current multiple.
Roughly, yeah. And that sharp contraction only happens mathematically if earnings are expected to grow massively, which they are.
We saw those ambitious targets.
All right. Analysts are forecasting substantial adjusted diluted EPS growth for 2025. The consensus seems to be somewhere in the range of 17% to 23% growth.
17 to 23% earnings growth. Okay.
So that premium valuation today, it's essentially the market saying, we see the strategy, we see the execution so far, and we believe you're going to hit those high growth numbers, and fundamentally improve the profitability of this business. It's pricing and success.
All right, this has been a really comprehensive look under the hood of U.S. foods and this a surprisingly dynamic distribution industry. Let's try to boil it down. What are the core takeaways for listeners regarding USFD?
I think there are three main things to really grasp. First, USFD's recent success, especially the margin improvement, is largely being driven by internal actions. These self-help initiatives, the tech like MOS, the push into private labels, the focus on operational efficiency, they're working. Are not just riding the market, they're actively manufacturing better profitability themselves.
Okay, takeaway one. Internal execution is driving profits. What's number two?
Second, the fundamental strategy here is a pivot. They are trying to transform the role of the distributor, moving away from just being a logistics cost center that drops off commodity product
Right, the box dropper.
towards becoming an indispensable tech-enabled operational partner for their customers, especially restaurants. MOS and Pronto are the tangible proof points of that strategic shift in identity. They want to be embedded, not just transactional.
Makes sense. Pivot to partnership. And the third key takeaway.
Third, that potential merger exploration with PFG is genuinely significant. It's not just about getting bigger. It signals that the future competitive landscape in this oligopoly likely requires massive unified scale. Scale specifically needed to fund the next waves of very expensive technology and automation investments needed to keep pace with and effectively compete against the market leader, Cisco.
Scale to fund the tech arms race. Got it.
Okay, that brings us to our final provocative thought for you, the listener, to mull over. Let's hear it.
If U.S. Foods and Performance Food Group actually do combine, they would instantly control a really substantial chunk of the entire national food distribution market, right? Second only to Cisco.
Absolutely. A very powerful number two.
So could this merger do more than just unlock cost savings for them? Could it actually accelerate the whole industry's shift towards these really high-cost barriers to entry, the sophisticated automation, the proprietary digital platforms?
Interesting angle.
I mean, if competing effectively suddenly requires hundreds of millions, maybe billions, in ongoing capex just to keep up with the tech and automation deployed by the top two giants, does that create an almost insurmountable moat? Does this kind of consolidation ultimately make it almost impossible for those thousands of smaller, regional, independent distributors to survive in the long run?
Will scale and technology essentially price the little guys out of the game entirely over time, squeezing the fragmented part of the market?
Exactly. Will the future be just two or three massive tech-driven distributors dominating everything? Something to chew on.
Definitely something to think about. We'll leave you with that thought. Until the next deep dive, stay curious.